Hey everyone, Dr. Tom Gerard here, and I'm in my home office for the summer going through this course, and we're going through chapter by chapter. I'm giving you a quick overview of the chapters that's coming up. And in this chapter, we're going to be talking about what we call long-term or fixed assets. So the word fixed assets means fixed, like it doesn't move kind of thing, like a building or something like that. But fixed assets are really just assets that you maintain and hold for more than a year. So it could be vehicles like cars and trucks, even though we know they're not fixed, they're still fall into that category. Sometimes you'll hear people say FF&E, furniture, fixtures, and equipment, because those are kind of things that we would purchase for a business that we're using in the business, and we're going to be using it for more than 1 year. So remember, our time frame in accounting is typically 1 year for current assets, current liabilities, which we'll be looking about in the next chapter. But right now, we're talking about long-term assets or long-term liabilities, which we'll talk about in a later chapter, which are things that we owe. We owe debt for long term. We buy a fixed asset. Maybe we buy a multi-million dollar machine or piece of equipment. We're not going to pay for it all this year. It's going to be a long-term liability where we pay for it over a long-term period of time. So we're talking about the asset itself now. Now, how do we account for that on our records? So we're going to talk about depreciation in this chapter heavily. You'll go through it and learn there's 3 different ways to calculate depreciation. The one thing to know about calculating depreciation on the accounting side for our financial records, because remember, this whole course is about how do we prepare our financial records. It's not about how do we do taxes, and how do we do acquisitions of businesses, those kinds of things. So accounting for fixed assets for our financial records is different than what you would say when we're saying depreciation for your taxes or something. Another thing to keep in mind whenever we're talking about things in accounting, we have to know that the way that the world, I'll just say the world, or other people, non-accountants use the word depreciation is different from the way we use the word depreciation in accounting. Because remember, we're very precise. We have to be objective on how we're calculating these things. And sometimes, people think about depreciation like, oh, well, I have my depreciation in my car. I bought a brand new car. As soon as I drove it off the lot, it went down in value. It depreciated. And that's the way people use the word depreciation in the world. But we need to think about, how do we account for depreciation? How do we define it as accountants, right? And how are we going to calculate it on our financial records? So go in here, you'll see, of course, fixed assets I described. We talked about depreciation. There's actually 3 different ways that we use depreciation, that we calculate depreciation, I should say, for our financial records. And those 3 ways are the straight line method, which is pretty much just what it sounds like. The units of activity method, which is another very good method, because maybe we buy many times, if you're in business and you buy a piece of equipment, even, my great examples I'm always using is the guy mowing the lawns. If you buy a $10,000 zero-turn lawnmower for your lawn mowing business, one of the things it has on there is the hour gauge, and it says how many hours have you drove this lawnmower. Obviously, if I'm buying it to mow my lawn at my house, I'm mowing maybe an hour, if that, every week or every 2 weeks, and maybe not even all year long. If you live in states like I do, where you don't mow your lawn year round. I, grew up in California. We mowed our lawn every week, almost every week, maybe every other week, all year long. So, but the point is if I'm using this lawnmower for my business, I'm going to be mowing maybe 8 hours a day. So every single day. And so this units of activity could be hours. How many hours have we driven this lawnmower for this particular year or this month or whatever it is, right? The units of activity, as opposed to the straight line, right? And then the double declining balance, you can read about that. That's for an accelerated depreciation method. And it is used in business many times. And many times these things are used because they're legal ways that a business can, how shall I say this without it sounding bad, but we're really manipulating our revenues, our profit margin, I guess I should say, because our depreciation is an expense. It comes off of our revenue. So we have revenue minus expenses is our profit. And if we have more expenses, then that lowers our profit. If we have less expenses, then of course that makes our profit higher. And one of the ways that you can legally manipulate that is, how do you choose which of these methods of depreciation do you choose? And in some cases we want double declining, which means it's declining faster, meaning we're writing off stuff faster in the beginning and less at the end, meaning that our profits are going to be lower in the beginning and higher in the end. And this chapter kind of goes through a lot. Now, when we have an asset, we get rid of it. We don't always get a return. In other words, you imagine, okay, I bought this pickup truck for $40,000 to drive in my business, and I've depreciated it over a period of 5 years. But at the end of 5 years, it may still have a value. It may not be worth zero. It might be worth only $5,000 or $2,000 or $10,000. I don't know. But at the end of the time, you're going to get rid of it. You're going to dispose of it. And so you need to know how to calculate for the money that comes in that you sell it for. So the other thing I will say quickly about depreciation is, when we're talking about some things that go into it, we need to know the time frame, we need to know the cost. And how do we calculate the cost that we're going to depreciate? Well, first of all, it is the actual cost that we start with. So if to put it into service. So if I'm buying the vehicle, the $40,000 truck, let's just say the sticker price was $40,000. But I've got to pay a destination fee, I got to pay taxes, I got to pay, maybe I'm going to put a special toolbox on the back, and that costs, $5,000. And anything we put into that asset to bring it into service is the initial cost. Now we have to subtract what we think we're going to get in the end. So this disposal, if we think we're going to, that in 5 years, let's say I'm using a 5-year term, because again, you have to know the time frame. Remember, the time frame can be different for your financial records than for your taxes. But for this purposes, let's just say we're going to straight line depreciation, which just means we're going to take 5 years and divide it each year by whatever this cost is. But the cost is not so much, it is the initial cost, so it's the $40,000 for the truck, plus the taxes, plus the toolbox, plus all these things. But at the end of the 5 years, we think we might be able to sell this truck for $10,000. So whatever that is, let's say it was $55,000 total for the beginning, and then we're going to sell it for 10 at the end, then we can really only depreciate the $45,000, not the full $55,000. So that's also things to keep in mind when we're talking about that. The other thing, one more thing on depreciation is when we're talking about land. So when you buy a piece of property, so first of all, land is not depreciable, because the idea is that the idea is that if I buy a building and you happen to be here in Oklahoma and a tornado comes and blows the building away, the land that it sits on is still the land, right? So the issue for this, and this obviously at this particular class doesn't necessarily go into all of these details, but when you buy a house, you say, well, I'm buying this house and it's $250,000. But when you buy the house, you're buying the land and the house. There's nothing on there that says, well, the land was actually, $50,000 and the house was $200,000, right? Now, maybe you did if you built your own house, but in general, you're buying the house for $250,000. It's not divided up between land and house or building, say. But as an accountant, we have to take off the part for the land. So we have to have, many times in commercial properties, you have to have special appraisals that, people that are experts in this can come and say, well, this is how much the land is worth if the building wasn't here. This is how much the building is worth. And, they specialize in that. We don't get into that in this chapter. Just knowing that land is not depreciable. So if you're buying a $1 million building, but it's sitting on land, then you have to determine, well, how much of that $1 million is for the land and how much of it is for the building. Now, I say all that because one of the last things that they cover in this chapter, well, actually two more things, and I know this is a long video, but for this, but I want to give you just kind of heads up on how this stuff works. Depletion. So what if I bought, you just said, Dr. Gerard, that we don't depreciate land, but what if I bought a forest? I bought a piece of land that had a whole bunch of trees, and we're going to cut down the trees and sell the trees. Or maybe I bought the land and I bought a mountain, and in that mountain is gold, and I'm going to tear down the mountain to get to the gold, right? So this is what we call depletion, accounting for natural resources, including the journal entry for depletion. So depletion, when you hear the words depreciation and depletion, we're talking about depletion we are talking about kind of a land thing. It's the land I bought with the trees, or the mountain I bought to get the gold out. And there are special accounting for depreciation of that land, because in this case the land is actually losing value because the land had trees on it, and when I sell it, it won't have any trees on it, right? Okay. So now the last one is intangible assets. Now, intangible assets is a very interesting thing because think about, they say that one of the things that, let's take the company McDonald's, one of the most valuables, I won't say the most, but perhaps it is. When we're talking about intangible assets, one of the most valuable things that McDonald's has is the golden arches, right? But is that a physical fixed asset, an arch? Well, maybe on some of the older ones, when I was younger, that's the way the McDonald's were built. They had the big golden arch right through the building. And so you can say, well, yeah, that's a physical asset. But now the golden arches have meaning, right? And when you say the golden arches, everybody knows you're talking about McDonald's because it has value. So that golden arches has value, but it's an asset. The reason why, if I was buying a franchise of a business, well, I could buy Charlie's Burger Stand, for maybe $100,000, or I could buy a McDonald's, and I don't know how much a McDonald's sells for, but I'm sure it's in the millions. So, but what are you paying for? You're paying for, of course, the process, but you're also paying for the golden arches, the brand. The brand has a great value, and marketers spend hundreds of millions of dollars on creating the brand for a company, right? In fact, one of the more recent ones is Procter & Gamble paid, I think it was, was it 300 million or 900 million, a huge amount of money to buy Old Spice, and then they turned around, they spent another probably millions of dollars in marketing to turn around the brand of Old Spice, which had been around since, before World War II. But the brand they bought, they didn't buy this. I mean, obviously, I suppose they get the smell, but now they have Old Spice has all kinds of smells. That maybe the original Old Spice was one smell, right? If you remember that. But they bought the brand. They wanted the Old Spice. So these things are bought and sold all the time. Procter & Gamble sold off Duracell, I think, to Warren Buffett and the Berkshire Hathaway group, but I don't know, all the details, because those things are bought and sold all the time. One of the trivia, now I know I'm going to stop before 15. I know I only got less than 30 seconds, but but I want you to think about brand and how valuable that is, right? And many of the things that we have to know how to depreciate that. If I spent $300 million to buy Old Spice, we got to put it on our financial records that I spent $300 million, and I've got to depreciate that. I don't have to, but I'm going to depreciate that over a period of time. And how many years is that valuable? How much is it going to be worth when I'm done with it? Wow, that's a tough question, right? So anyway, there you go. This is a full chapter, just like all of the chapters in Introduction to Accounting, but it's really fun because you learn a lot of stuff that the people that don't know about accounting, they're confused when they hear the word depreciation.